All right, today we are going to tear down probably the very first rule of trading you ever learned. Always use a stop loss. We're going to take a hard look at this idea, one that's drilled into us from day one. And honestly, it might completely flip how you see the markets forever. Think back to when you first started. The first rule they probably told you was, always use a tight stop loss. It's sold to us as the foundation of smart trading, right? Your shield against all the chaos. But what if it isn't a shield at all? The thing is, sticking to that rule religiously doesn't actually protect retail accounts. In fact, if you look at the data, it seems to do the exact opposite. It pretty much guarantees a slow, painful death by 1,000 cuts, knocking you out of trades right before they were about to turn in your favor. To make it in today's markets, and especially as we look ahead, you have to unlearn this old idea of safety and really start to understand liquidity. Now, I gotta give you a heads up. If you're an active trader, you will probably disagree with what I'm about to say. You might even think it's crazy. Okay, so let's dive into why this belief is so mainstream in the first place. We gotta understand why the stop loss became this sacred, untouchable tool. Because, on the surface, it seems to make perfect sense. So the textbook definition is super simple. It's a preset order that tells your broker, hey, if the price drops to this level, sell my position. The goal is clear, right? Limit your losses, make sure one bad trade doesn't completely blow you up. But here's what's really going on. Its real power is psychological. All the trading educators, all the brokers, they push this concept so hard because it's a psychological crutch. It gives new traders who are terrified of volatility this feeling of control in a world that is, by its very nature, uncontrollable. And the logic, it seems so clean, doesn't it? On one hand, you have this neat little formula. Cap every loss at 1%, and you can survive forever. It makes trading feel like this solvable engineering problem. But the reality is that the market is a chaotic storm. This thinking just frames the problem all wrong, treating this wild beast like it's a predictable machine. Now, this is where it gets really interesting. This illusion of safety isn't just a flawed idea, it's an idea that is actively being used against you. This is how your protection literally becomes the target. So this is the question you have to ask yourself. Do your stops protect you from the market, or are your stops the market for the bigger players? For them, all those retail stop orders are just a big, predictable pool of liquidity waiting to be scooped up. And this works because modern markets are mostly just noise, not a clear signal. All those little short-term wiggles in price are basically random. So when you put a tight stop loss right at an obvious technical level, you're almost guaranteeing that you're going to get shaken out by normal, everyday volatility, even if your main idea about the direction was totally right. And this brings us to the core concept here, the liquidity grab. And listen, this isn't some conspiracy theory. It is a fundamental mechanic of the market. If you're a giant institution and you need to buy 1 million shares, you can't just hit the buy button. So you have to find a huge pool of people who are being forced to sell. And where do you find that? Well, it's a pretty simple 3-step dance. First, there's the hunt. Algorithms sniff out those obvious price levels where everybody has placed their stops. Then comes the trap. The price gets pushed just far enough to trigger that waterfall of sell orders. And finally, you get the reversal. The institutions dive in, absorb all that liquidity on the cheap, fill their massive orders, and the price just snaps right back, leaving everyone else completely stunned. So think about it like this. Your stop loss is not a shield. It's a public announcement that you're willing to sell your assets at a steep discount to the smartest players in the game at the exact moment of maximum panic. You are literally handing them your inventory on a silver platter. Okay, let's talk about the elephant in the room. I know exactly what you're thinking right now, and it's the most common, most logical pushback to this whole idea. This is the big one. This is the ultimate fear, and it's a completely valid one. The idea of trading with no safety net sounds insane, right? It feels like you're just asking for one bad move to completely ruin you. But this fear is actually based on a deep misunderstanding of what risk really is. The big mistake is confusing stop placement with actual risk management. Real risk isn't managed by drawing some random line on a chart. That's just picking a place to panic. No, real risk management happens before you ever enter the trade, and the tool for that is position sizing. And here's the bottom line. If a 20% move against your position is enough to wipe you out, the problem was never the lack of a stop loss. The problem was that your position was way, way too big to begin with. Sizing correctly is what gives you the breathing room to ride out the market's normal chaos without being forced to sell at the worst possible time. All right, so let's bring this all home and talk about why this shift in thinking isn't just some interesting little theory, it's fast becoming a basic requirement for survival. In the AI-driven markets we have today, visibility into the order book is basically perfect for the big institutions. Their algorithms can see exactly where those big clusters of stop orders are sitting. So placing your stop at that obvious support level is like painting a giant bullseye on your back. So what that means is that using these decade-old retail tactics is no longer the safe or conservative approach. In this new world, it is actually a high-probability path straight to failure. The game has totally changed, which means your strategies have to change too. Professional risk management, the kind that focuses on position size and allows for volatility, it can look absolutely reckless to the untrained eye. It can feel totally wrong. So if this whole idea makes you feel a little uncomfortable, that's probably a good thing. Now you just have to ask yourself, why?